thanks for joining us for the next installment of Bridging the Gap. I'm Lisa Kirschenbauer, founder and president of Omega Wealth Management. And as always, I'm here with my colleague, Jared Jones, director of investments and lead advisor for Omega. How are you doing today, Jared?
Doing well.
Yeah.
Feeling like fall.
It is definitely feeling like fall, and we're also at tax time, which is why today's issue is going to be all about taxes. So as the title indicates, we've launched our show to bring you different perspectives on money and the markets and life, whether it's the lens of gender or generation or political orientation, and we will be talking a little bit about politics today. We hope to inform, educate, and entertain you. So we decided that we were going to focus on two different issues, but both under the same theme today, and that theme is taxes. It is October 15th as we record this. That's a big day for a couple of reasons, but mainly, anybody who hasn't gotten last year's taxes filed, they're doing it. So CPAs are really busy right now. But for us, this is really the beginning of doing some tax planning, fall tax planning. And so I'm going to talk a little bit about what we do here at Omega and why that's important. And then item number 2 is that, hey, we've got an election coming up, don't we, Jared?
We absolutely do. It's that time of the cycle.
It is. And so there is some speculation about, depending on who wins, what might happen with taxes. So we're going to tee up that conversation, and we're going to speculate a little bit today until we actually have some real answers. But just get you thinking about what might change and what you might be wanting to do from a planning standpoint. So let me start with the first topic, which is it is fall tax planning time here at Omega. Our colleague, Kathy Frakes, Director of Financial Planning, leads that effort for us, but it is absolutely a team effort. And our goal here is, because we are financial planners and we look at our clients' entire situation, of which tax is a big part, we want to make sure that we're planning ahead and trying to prevent any surprises come next April. And the only way that we can do that is to start talking about and looking at where our clients stand from a tax standpoint here in 2020. So what goes into that? Let's talk about that a little bit. Jared will probably have some insights as well, because he does helps with some of this also. There's a number of different things that we're looking at. First, we want to see what has your income been for the year, whether it's Social Security or a pension or earned income, or maybe you had some sort of windfall. We want to take that into account. And we've been gathering those notes all year, by the way, as we've talked to you. Then, in addition, we want to look at what has the portfolio contributed to your taxes. Now, that's an interesting one that I'll let Jared cover in a minute, because we're seeing some different things as far as the portfolio impact on taxes this year. So we take that into account. And then the real wild card that comes up for a lot of people is the capital gains distributions that, if you're in mutual funds, are paid out normally right before the end of the year. So I'll give you the quick primer on this. So within mutual funds that are a market basket of stocks and bonds, or a combination or one or the other, during the year, the portfolio manager will buy and sell individual stocks and bonds. By law, at the end of the year, if they have a net gain on the portfolio, they have to distribute that to shareholders. That's you. If they have a loss, they get to hold that and apply it against gains next year and into future years. Now, what I can tell you is, after the financial crisis, we had a lot of internal losses within mutual funds, but over the years where things recovered in the markets, all of those losses went away. So what we've seen over the last few years is that mutual funds have been paying capital gains. Jared, maybe you can talk a little bit about why this year might be different, both on the capital gains distributions and then also what the portfolios are actually generating, especially if you're in managed accounts.
Yes, so I think what we're seeing from portfolios, it's a little different for everybody, but I would say generally what we're seeing for our clients at this point, and we're recording this in mid-October, so preface that if there's any big changes coming up, depending on when this gets posted. But what we're seeing right now is most of our clients have significantly lower gains than they did at this time last year, or to finish 2019. And that's important to communicate to your accountants, because oftentimes when accountants are running end of year tax planning projections for clients, they'll just use what happened last year unless we tell them otherwise. So we're trying to communicate as best we can with accountants to say, hey, we'll have this information to you probably in the first week of December. If you could hold off on, telling the clients to pay before that point, if possible, we'd really appreciate it, because we are noticing lower gains that have been generated in the portfolio throughout the year. And it's really I guess it's a win-win, right? Oftentimes when you have losses that offset some of the gains that we've seen, it's because the stock market hasn't done very well and you have negative performance. I think right now we're at maybe break-even performance in most of our clients' portfolios, maybe a little bit ahead given the day. But we've also had some losses that we took earlier in the year to help offset some of the gains that might have occurred later on in the year. So it's been a win-win year. We're making lemonade without really any lemons. So that's a that's
Hey,
a good
Jared,
thing.
let's talk about one thing that I know confounds investors sometimes. And this has happened in the past. I've been investing long enough to see this, where we have a year where somehow we have capital gains distributions, and even if you reinvest them, you still have to pay taxes on them, unless you've got some losses to offset other places. But your portfolio doesn't do really well. So how does that kind of thing happen sometimes, where you've got to pay taxes on your investments in a year where the performance isn't that great?
Yeah, I think you have to look closely at the asset classes that are built into the portfolio. So this year, we talked about overall the portfolio is probably about break even at this point, but there have been bright spots. Bonds have done well, and large cap stocks, big companies, particularly large growth companies, have done very well. So it depends on where you take off the portfolio, if you're taking any money. And it's always a crapshoot what we're going to see from mutual funds. Usually we get some guidance in the middle of November as far as what we'll see from capital gains distributions. But I hear you. It's not a good feeling when you're negative on the year and then you still have to pay some capital gains taxes. And we like to try, and our big thing with tax planning, right, is no surprises. Like if it's going to happen, we want to be out in front of it. We'll try and let our clients know as best as possible and plan to mitigate it if we can. So that's our philosophy.
So let me talk a little bit more about the process. So now we figured out what is your earned or pension or windfall income. We figured out whether maybe we sold some things during the year that created realized gains or losses. Then there's the capital gains distributions piece. So we've already got 3 elements. Then what we do is we send that off to the accountant, or if you're doing your own taxes, you've got to actually go through maybe TurboTax and do a pro forma for yourself. And you got to figure out, are your deductions the same? Did you have the same charitable deductions? Are they different? Is there something else that has changed for you during the year that might impact the tax calculation? And then we want to see, well, where do you stand? Have you paid enough in so that you don't have penalty? Are you going to owe a bunch in April? Do you need to make a January payment? So all of that goes into our work with your accountants to determine where are you going to stand from a tax planning standpoint. Now, we do all that before the end of the year, because the last thing we want to figure out, and there are some opportunities this year. One is perhaps if your income has dropped a great deal, you might actually want to do what we call a Roth IRA conversion, where you take a traditional IRA that eventually when you have income come out of it, you have to pay taxes on it. It's a tax deferred vehicle. You actually take money out of it, pay the taxes, put it into a Roth IRA, which will now grow tax-free for you in the future. And for some of our clients, that's going to be an opportunity this year. That's one thing. And the other thing, and I'm going to let you talk about this, Jared, is that we may want to do donor advised fund contributions this year, or other charitable contributions. So maybe you can talk about that as well.
Yeah, so donor advised funds are a great tax planning tool that we often use with our clients, especially when they have large capital gains years or big income years in general. So the way a donor advised fund works, I think you best describe it as a mini foundation, but you can't call it a foundation. I guess there's some legal limitations on what is called a foundation. But you set it up, you fund it before the end of the year. That's important. Some of the tax deadlines fall on when you file your taxes. This deadline is it has to be in by December 31st of the end of the year for it to count in the tax year. So that's important. Oftentimes we'll be setting up some of these for clients at the last minute and holding our breath and crossing our fingers to get it funded. But in the year that you make a contribution, that's when you get the full tax benefit of the charitable deduction. And then you're not required to give it out to a 501c3. So it's really a great tool if you want to take full advantage of the tax deductions and you don't necessarily know where you want to put all of that money. You don't want to give it all to one charity in one big lump sum, because then you'll wind up on some email list and hear from them over and over again. So it's a great tool, I think. And we're going to talk about politics. This is another tool I think that might be on the chopping block down the road, but we'll see. Right now, it's a great tax planning tool.
Well, now, Jared, can you put in, does it have to be cash? Can you put in investments? What can you put into it?
You can put in either what's called highly appreciated security. So anything, we look for what's the best bang for your buck. So if you have any low cost basis stocks that have done really well, let's say you bought Amazon back in 1998, the cap gains on that is going to be pretty ridiculous. Let's say you have that, you don't want to sell it to realize the gain, so you can donate that and you get to deduct a portion of the gain. So I think with stocks, it'll be 30%, or at least it used to be. These things change. So
we have some special rules for this year, so you have to check with your accountant because of the CARES Act. The other thing, though, that we've donated a lot for clients are those oil stocks. Not everybody is real keen on the fossil fuel stocks these days. And so that's been a nice way to take those out of the portfolio without having to pay the taxes on the gains, right?
Absolutely. Yeah. Oil stocks are the old school FANG stocks, I think.
Yeah, they are. And the other thing, I think we've seen is with some of our clients where they want to start to create some values and family legacy around giving back in the community and being charitable. Getting your adult children or even your young adult teenage children involved in where the grants are made out to. But just as a reminder, unlike when you do charitable, direct to a charity contributions, you get to take the tax deduction right then and there. This is a little different. You get the tax deduction when you put the money into the fund, and then you can take your time, as you were talking about, Jared, doling it out. So it's, especially when we've had clients sell maybe a first or a second home and had a big gain, maybe sale of a business is a great opportunity. Any other sort of big windfall, just a big high income tax year is a great time to get one of these in place and make a more sizable contribution. It's really helped some of our clients offset the taxes they would otherwise pay.
Absolutely, yeah.
All righty. So, last thing for our business owner clients I want to say is, obviously this has been a rough year. Hopefully, if you've been working with your accountant, if you had any losses in prior years, they changed the rules with the CARES Act, because of the coronavirus. And so you might be able to go back and apply prior year losses against gains and maybe amend a tax return like from last year or something if you had already filed. So there are some special things for business owner clients that we want to make sure you're taking advantage of and really doing some good tax planning, because certainly you don't want to be sending money to the IRS if you're not having a great year, because that's a cash flow crunch for you. So we welcome, any questions, emails. Please reach out to us, because we want to work hand in hand with your accountant to make sure that we're helping you really work through the tax planning and the cash flow planning for the year. So a lot there. Let's change gears, because in a few weeks we have that election coming up, and we've already talked about it a bunch, but we're going to talk about it again today a little bit as far as what might change. So Jared, why don't you tee this one up for us?
Yeah, I think the big thing that we're starting to pay attention to is the blue wave scenario. I guess that's what it's called, right?
Or the tsunami, or the, oh, we don't
Tsunami,
even have a word for it, is what I've also heard.
Okay. Well, we're looking at a scenario where the Democrats sweep the election. If we pay attention to the polls, which take that as you will, it looks like Biden has a considerable lead on Trump at this point. What's more interesting is to look at the Senate. There are some close races, like with Susan Collins and Lindsey Graham and Tom Tillis in North Carolina and a couple others, that could flip the Senate to be controlled by the Democrats. It looks pretty likely that the Democrats will retain control of the House. So when you get a scenario where you have one party controlling all three branches, in theory, right, it could happen or could not happen, but in theory, legislation will go through a lot easier. And what we're looking at are some of the tax changes that are being proposed, specifically around capital gains taxes. There's been some talk about raising the tax brackets, and we could talk about that. But I think the more interesting scenario is capital gains rates increasing from where they are right now, where the vast majority of people pay 15% on capital gains. If you're a very high income earner at the top of the bracket, you'll pay 20%. But it's a much better deal than paying ordinary income on that gain, which is what's being proposed, is shifting the capital gains rate to match your ordinary income rate. So that could either be not a big change for you, or it could really hamper you if you're a high income earner. You could see it potentially rise from 15% up to over 35% given the year. So that brings up some interesting tax planning. And there's a lot of nuance that goes into this. It's not going to be a one size answer for everyone. I think that's important to say, but I think what we're looking at is, could there be a scenario in the stock market where people say we want to sell, which creates some volatility and a decline in asset prices at the end of the year? And could clients be reaching out to us wondering if they should sell to take advantage of, we know capital gains are where they are right now. We think they could rise in the future given the sweep that the Democrats just had in the election. What do we do? So I don't know what your initial thoughts are, Lisa, but do you have anything to add?
Yeah, I mean, I think, this all may materialize or it may not materialize. I think we know that there's going to be a lot of volatility as we approach the election, probably in the few days after it, unless it's just really clear what the result is and it's accepted. Of course, that's the other half of this in 2020 this year. And then from there, as we get into the end of the year, prior to the new Congress taking over, there will be some speculation, and that, to your point, Jared, might lead some folks to sell to realize gains at a lower rate. Now, to be clear, if you were going to sell anyway and you were deciding between 2020 and 2021, because you needed cash or you were changing investment strategies or whatever it might be, we would probably recommend that you try to make that change before the end of the year.
I think it even depends, though. It could depend. Let's say you're about to retire and your income's going to go down. So it's not even as that easy.
You're absolutely right. I mean, if your income, if that part was equal and the same, but you knew you were going to sell soon, we might recommend that you do it in 2020 then versus 2021. But to your point, if you're going to have a big change, we've got some clients who are getting ready to retire, or certainly they're going to be laid off next year. And so we're really having to look at every single client one at a time to figure out what their personal situation is and decide what to do. Now, if you're a business owner and you are planning on selling your business and you think you can get the transaction done before the end of the year, well, you might want to do that. And I feel bad for the attorneys and the accountants who might have to help you make this happen. But if it's already in process and it's a question of, do we do this in December? Do we do it in January? It's worth looking at whether you want to get it done, get the transaction done before the end of the year. I think the other tax piece that we need to keep in mind, and it won't necessarily have an impact on the markets, but boy, some attorneys and accountants are going to get busy, and tax attorneys are going to get busy, and that is estate taxes. So there's also a lot of talk about, right now you have a lifetime estate and gift exclusion of over $11 million each, which means that $11 million of your assets, whether it's real estate or investments, can be passed on to your heirs without estate taxes. There is a lot of talk, certainly amongst Democrats, and it varies depending on who you're talking to, of taking that exclusion limit back down to the 5.5 range that it was before it got bumped up in the last couple of years. Now, for many clients, for many investors, this is a non-event. It still doesn't matter. But there is a whole group of folks out there, certainly some of the ones that clients we're working with, where all of a sudden that's going to make a change. And so there's nothing, I mean, you could be doing some gifting. Certainly if we get a change in the House, to your point, it matters, Congress matters because that's where legislation is. You may want to talk to your estate planning attorney and accountant before the end of the year to see if there's anything you would do. But we're not necessarily suggesting wholesale, gift all your money away before 12/31. So all we're suggesting is, hey, that might be worth a phone call, a Zoom call, unfortunately, to talk about some of that planning. The only other thing that I know is also being talked about, going back to personal income taxes, is for many people in blue states, we lost the ability to fully deduct our state and local income taxes. We have a limitation of $10,000 a year. If you live in California, New York, New Jersey, the District of Columbia, you are not getting to fully deduct you're getting to deduct all of your mortgage interest within some rules, but you're not getting to deduct all of your property taxes and any other income taxes that you're paying. State income taxes. So that is a change that may make its way back in. Now that would be good, right? So that would actually help lower your tax liability. So, we wish it was easy. It's not easy. There's a lot to consider. Every client situation is different, and we do try to deal with that on a case-by-case basis. So don't hesitate to reach out if you've got questions, you've got concerns. But there's a lot to watch this fall, isn't there, Jared?
Yeah, and one of the last things I'll add is just that the tax code is extremely complicated and complex. Just because we change the rates doesn't mean that a lot of the ways that people get around paying taxes are going to go away. We might see a few of them go away, but as true as American can be, right, as in American form, there's going to be a way to get around. There's loopholes. You can subvert the system if you want to. So it will be interesting to see what actually gets through in legislation and what remains. I think it'll be interesting. And we're not recommending making any changes to your overall long-term strategy based on speculation of what might get through. So I'll just add that.
Yep, I think that's a great place to end. As always, we really appreciate you joining us. Please be sure, if you want to keep track of when we put a new episode out of Bridging the Gap, subscribe to our YouTube channel. We also post on our website, and we welcome any ideas, any questions that you have. Some of you have been good enough to email us some questions so that we can talk about that here on the show. We continue to welcome that. As always, take care of yourselves. Please stay well. And as I've been saying to everybody, get yourself vaccinated for the flu and vote. Thanks a lot. Take care.
See ya, everyone.